And we're ready. Thank you, everybody, for joining us today and for waiting while we made sure everybody who wanted to join had time to hop in. We appreciate you taking time out of your day to join the Park Bank's webinar, How to Navigate Investments for Nonprofits. Before we begin, a little bit of housekeeping. If you have questions throughout this presentation, please send them through the Q&A feature on the bottom of your screen right next to the participants. We will be watching those throughout the program and we will answer them at the end. And based on how many questions we receive, we will answer all that we have time available to do so. Sorry about that. So once again, if you have a question, if something piques your interest, send it to us through the Q&A and we will be responding to you at the end of the program. With that, I'm going to introduce myself. My name is Peter Benson. I am the Senior Vice President of Business Services for Park Bank. I work with business clients and we have teams that work supporting businesses and specifically engaging the community and especially our nonprofits. We look to do these webinars to give you as nonprofit leaders, as nonprofit board members, insight into what's going on in the world and what issues you should be thinking of. And we bring in local experts to help guide the discussion. Today, I'm very pleased to be joined by Mike Hablewitz. Mike is a partner at Wegner CPA who has well over 20 years of experience working on the audit staff with a focus on nonprofits and compliance. As you can see from his bio, he's worked with a broad range of nonprofit organizations, and he especially enjoys helping his clients improve their internal controls to help prevent and mitigate fraud. On a personal note, I have had the pleasure of working with Mike and his team for the past several years with a nonprofit that I am involved in, and I can tell you that they do top-notch work, and I would highly recommend Mike and Wegner to anybody who is looking for a new or a change in accounting services. We're also pleased to be joined by John Friar. John is a partner at Park Capital Management. John has over 10 years of experience in the financial services industry. As a certified financial planner and accredited investment fiduciary, John works with businesses, nonprofit organizations, and individuals to ensure that their financial goals and those of their employees are appropriately managed through traditional wealth management, 401k, and other retirement plan consulting. With that, I am going to turn it over to Mike, who's going to kick off the presentation for us today.
Great. Thank you so much, Peter. Thanks for the intro. Good morning, everyone. Thanks for joining today. And thanks to Peter and his team for the invite to be part of this today and for the kind words, Peter. It's been a pleasure getting to know you a little bit and working with you and other members at Park Bank over the years as well. So yeah, just thank you again for including me today. Happy to be here. And I will do my best I think my part should be relatively brief. I want to make sure we stay on track and give plenty of time to John for the kind of the nuts and bolts of things. And then also for questions and answers at the end. So I think with that, we'll get started. First thing, Peter mentioned I work with lots of nonprofit organizations, and that's true for a long time. But I see the gamut of when it comes to investments of organizations that literally just operate out of the checking account, don't have any investments at all. To on the other side, organizations that have tens of millions of dollars in investments and are invested in all sorts of different investment vehicles. So I think the first thing when organizations are looking at investing is trying to figure out what do you consider to be investments, and then what types of investments do you want to be in. We see organizations that consider just savings accounts and money market accounts to be how they invest their money, that rather than just keeping it in a cash account. Liquidity is a big factor here. You want to make sure that the organization has the liquid cash to just meet payroll and other obligations and things as they come due. So you want to factor that in before maybe you necessarily think of more traditional investments, as it's not a big deal and certainly easy enough to transfer money to and from investment accounts. But that can be a bit cumbersome if you're doing that, on a daily basis or even a weekly basis. CDs is another area that organizations, before they maybe get into more traditional investments, is something that organizations will look at. Things like savings, money markets, and CDs right now are not going to get you a large return, of course, but they are better than maybe just having millions of dollars sit in a cash account, or a non-interest bearing cash account, which I've seen. CDs, you can do a variety of things. Of course, you want to look at what are your needs, short-term and long-term. Organizations may layer their CDs so they come due at different times. Some organizations use CDARS accounts, if you're familiar with those. That's where you're having money at a variety of different, it can be held, or you work through one financial institution, but you have the money held technically at several financial institutions. We see organizations do this if they're worried about about FDIC insurance excess, to try to spread money to different financial institutions to reduce their overage on that FDIC insurance or insured amounts. Third, there you see maybe more traditionally what people think of with investments is, hey, we're going to talk with John and we're going to open up an account and we're going to think about stocks, bonds, mutual fund, just more true investment accounts, which of course is going to come with higher risk and higher reward. And then finally, alternative investments. So other things, you could invest in real estate, you could invest in other organizations like an LLC, a limited liability corporation. We see lots of clients that open up accounts at community foundations. So for example, Madison Community Foundation here in the Madison area, where an organization will take money, turn it over to the community foundation. And there's all sorts of pros, and some people would argue there's some cons with those types of accounts as well. But a lot of people like to have those, particularly if they're going to have an endowment account. I'll touch on that a bit more later, but that's another potential option for investments, is looking at Madison Community Foundation or other community foundations. One other thing before we move on to the next slide, that I like to note is a lot of times when people, maybe an organization gets a gift, a large gift, and they're like, okay, we got a gift, or they have a certain new purpose that they're getting money for. Let's say they're doing a capital campaign. There's generally no requirement, unless there's some third party requiring it, but the vast majority of times there's no requirement to have separate accounts all the time for these different purposes. But sometimes organizations do choose to do that. So if they are doing a capital campaign for a new building, that, hey, we're going to open up this separate bank account, a separate investment fund, whatever it may be, you're certainly welcome to do that, but you don't have to do that. Occasionally we see organizations that have just a ton of different accounts, and it becomes a bit of an accounting burden. So keep that in mind, that it may make sense to have a separate account or accounts from time to time, but that is not a requirement. So, all right, investment policy. Important to have a policy. Just as an auditor, we always want to see policies and procedures and things that not only are in place but are documented. So it's important to have an investment policy when you decide to get into the investment world. Should always be board involvement. Absolutely, board involvement through each of these steps. So when you're developing and adopting an investment policy, that is something that probably discussed if you have a finance committee as a segment of the board. Work with the finance committee to develop, both management and the finance committee working to develop and adopt that. And then ultimately it should be voted on and approved at the board level, just like a variety of other policies. So things to consider: asset allocation, which I'm sure John will talk about in his portion of the presentation, but just thinking about how do we want to allocate our assets, whether a lot of times just generic terms, you talk about equities and fixed income, whether it's an 80-20 split, a 60-40 split, what's the right mix for you? Do you want to have CDs? Do you want to have some of those alternative investments? Just what is your asset allocation, maybe within an investment fund, but then also just high level to factor in any cash accounts or any other alternative investments you may have, including something like an endowment fund or other funds at a community foundation. Risk tolerance, of course, plays into that. John will probably talk about that too, I'm sure. Just when you're looking at your asset allocation, obviously, if you have lower tolerance for risk, you're going to have more things like fixed income and CDs and such. You have higher risk tolerance, you're going to get more into equities most likely. And you have to balance out kind of short-term goals and needs versus long-term goals and needs when you're thinking about your risk tolerance. I think what you want to do is have your short-term needs and goals in mind, but have a long-term plan. I can still remember to this day an organization prior to 2008 just had a bunch of CDs. That was their investments. Then they decided, no, we're going to get into stocks and mutual funds, and we're going to have some more traditional investments. 2008 happens. They lose a bunch of money. I don't want to say panicked, but maybe might be a bit harsh, but overreacted. And shortly after 2008, pulled a bunch of money back out. They lost a bunch of money naturally and didn't experience the rebound because of that. So I think in that case, their risk tolerance was probably pretty low, didn't match up with how they decided to allocate their assets. And as a result, it ended up costing them a lot of money, and they're more than a decade later still trying to kind of rebound back to where they were. So along those lines, work with the Johns of the world, work with your advisor when you have those investment funds. Talk with them frequently. I certainly have some clients that not necessarily every month, but maybe a couple times a year, maybe even quarterly, if they have significant investments where the person that they work with joins their finance committee and or board meeting. So that's a good idea to just work closely with them and make sure that asset allocation is matching up with your risk tolerance. Monitoring the policy, just like anything else, monitor it just to see if it makes sense as your needs change or your goals change, the financial position of your organization changes. Does it require to be changed or amended? And then same thing, that should be board approval, just like adopting the original policy. If you're going to tweak something and amend it, document that, approve it, or vote on it, approve it, make sure that then the new policy is in place and everybody that's involved, staff, management, and board, knows that, hey, now this is our amended policy. We do have a sample investment policy on our website. It's actually a combination of an investment policy and a reserve policy. We'll touch on reserves for a minute or two in a bit as well. But there's certainly others out there that you can search for. Maybe John has some too, but there is one on our website under the nonprofit link. There's a resources tab or button they can push, and there's all sorts of samples on there, and one of them is an investment reserve policy. All right, so that's kind of just high level types of investments and putting a policy in place. Just a few things from, I got to talk about accounting, being an accountant. So some things to consider when it comes to the debits and credits is do monthly and quarter reconciliations just like you do with a bank account. So if you have an investment account and it's got gains and losses and interest and dividends, and those accounts should be reconciled just like a bank account. I'm actually surprised how often organizations don't do that. When it's difficult from a board perspective, if you're at a board meeting or a finance meeting and you're looking at financial statements and those investments are the same as they were at the end of prior fiscal year or something like that. So make sure you're recording those gains and losses, interest and dividends. And various organizations do it differently. Some organizations just generically have an investment return account. So it's just, hey, we had an investment for 200,000, now it's 220. They have an investment return account that shows a gain of $20,000. Other organizations get into more detail into realized gains or losses, unrealized gains and losses, interest and dividends, and maybe have 3 or 4 different accounts that they break it down further. So that, I would say, I would leave that up to an organization's discretion, but definitely adjust those balances on a monthly basis, ideally, but quarterly for sure. Adjust it to fair market value as the second bullet point notes there. So just when you're presenting financials then to at the board level or finance level, it's like, yep, this is as of the end of the last month, this is the fair market value of our investments. Budgeting is another piece for investment return. We see a variety of ways that organizations think about investment return. A lot of organizations, which I kind of like, will budget for no investment return. And the reason why I like that is the investment return, hopefully we'll kind of ignore 2022 so far, but for a long stretch, obviously we had a good run, I almost consider that to be gravy. It's like, okay, let's balance our budget. Let's be confident that the organization has the income to cover expenses without relying on investment return. And there's nothing wrong with budgeting investment return, but I think if you do that, you want to be cognizant of that. Like, hey, if we did back out what we're budgeting for investment return for the year, we're going to budget a flat 5%, 7%, whatever it may be. Okay, let's back that out. Are we still balancing our budget, or are we relying on our investment return to make up a difference? And naturally, you don't want to rely too heavily on the investment return. I look at that all the time when we're doing audits of, okay, your bottom line for the year was X. What was it if you back out the investment return for the year? So more operationally, how did the organization do? So just thinking about that from a budgeting perspective. Then endowments, just on the last page, just one more comment on endowments. This is something I could be a whole half-day webinar on itself, is talking about endowments. So I won't get into a lot of detail for that. But these are just, when we're talking about accounting for investments, endowments can become a whole other animal. So if you have endowments, same concept, you need to adjust for gains and losses and things like that. But things can definitely get muddied if you have endowments that, particularly if they're made up of 2 types of money, if you will, where maybe you have an endowment for a certain purpose and you have donors that are giving money that are restricted for that endowment. And then maybe the organization is also choosing to give an influx of money to that endowment to grow it. And you end up with both an internal board designated portion of the endowment and what I call an outside restricted portion of the endowment for donor restrictions. And then you get into accounting for, okay, if there's gains or losses, how do you allocate, like what's board designated, what's donor restricted from the earnings and such as well. So there's a lot of accounting considerations related to endowments and investment funds that are tied to those endowments. Again, that's almost a whole nother topic. But if you have questions on that, that's definitely, if you have endowments, that's definitely something you want to talk to your accountant and or auditor about. All right, internal controls. Also, Peter mentioned that when he was reading my bio. Internal controls is a big piece, as many of you probably know. When we do audits, we don't just look at numbers, we also look at internal controls. So important to have controls for your investments as well. Just like you do your bank accounts. A lot of times organizations, and rightfully so, are worried about the controls over the cash, just money in, money out. Same concept though with your investment accounts. So who has the read access, who has write access? Or I like to say, who are the doers and who are the reviewers? So who has the ability to add, withdraw, transfer funds between accounts? and then who has the ability to just monitor things. So a lot of times you see the same thing with cash accounts. Okay, you got an accountant who has online access, who can cut checks, who records checks in the accounting system, but then there's somebody else who's monitoring that, who maybe doesn't have the ability to make transactions online or record things in the accounting system, but they have the ability to go online and monitor the bank account. Same thing with investment accounts. You know, somebody should have the ability to go in there. Maybe they can't move funds, but they have that read-only access where they can go in and just say, hey, all right, we see probably less concerned about money coming in, but then if we have withdrawals or transfers, do those make sense? Are they withdrawals and transfers that we anticipated or we talked about at the board or finance level, and just monitoring it from that perspective. And I have noted there dual controls. Some organizations, particularly ones with a lot of investment, a lot of money in investments, they will actually require two people to quote sign off on a withdrawal or transfer. So if Jane Doe reaches out to John and says, yeah, I want to move $500,000 from our investment account to this cash account, then if Jane Doe is the accountant, it might also require the executive director to approve that as well before John would work to make that transaction happen. So dual controls in anything, not just in investments, is never a bad idea. So that's something that I have a few clients that they've implemented that where hey, no money's being moved out of there unless two people sign off on it. Also, are withdrawals limited? Is it set up so that if there is a withdrawal or a transfer out, that it can only go to certain accounts? So it might seem kind of crazy or a long shot, but to make sure that somebody couldn't go in and just drain the investment account and somehow withdraw all the money and put it into some personal account and walk off with thousands or millions of dollars. So are there limitations so that when there is a withdrawal, for example, it can only go from the investment account to the organization's checking account, or only to the organization's checking or savings account, something along those lines? And then I've already touched on oversight and monitoring. So a lot of times there requires some board or finance oversight or monitoring just to make sure that these controls are in place, so to protect the assets of the organization. And I think final slide for me, just touch on reserves a little bit. This naturally correlates with investments. So this could be another topic in itself too, is just talking about reserves for an organization, particularly for nonprofits, and what does that mean? You know, think of investments as part of your operating or other reserve. Sometimes it's an endowment, and then you have this, hey, these investments are quote tied to our endowment, but in many other cases, investments are just, they're yours, they're the organization's money, and that should be part of your reserve, just your thoughts on reserve and your goals, your needs going forward. So lots of organizations have an operating reserve. Some, I mentioned earlier, the example of having a capital campaign. There might be a capital campaign that's tied to your investments, or sometimes there's just a capital reserve. Hey, we have a building and it's going to need a new roof in a little while. It's going to need a new parking lot, whatever it may be. Hey, are you going to set aside some money in investments for those types of reserves? So keep that in mind when you're thinking on investment and how it ties to your reserves. Naturally, liquidity considerations when you're dealing with investments and reserves, make sure that correlates with your asset allocation. To my example earlier, don't get caught with everything in investments and then you got to pull it out at a huge loss when you have cash needs. That's of course not ideal. So again, balancing those short-term and long-term goals and needs, and then consider a reserve policy as well. I mentioned the sample we have is tied into one policy, investments and reserve policy, but a lot of times there's two different policies, which is fine. But if you have different reserves that you want to have, an operating reserve, a capital reserve, et cetera, those should be talked about and put into a policy as well, and maybe even having some goals in the policy as far as, hey, we're going to grow this reserve to this dollar amount, by this time frame, et cetera. Okay, well, I think that's everything I had. With that, I will turn it over to John.
And thank you very much, Mike. I'm going to jump in here while John gets himself unmuted and say thanks for a lot of things to think about, Mike. And I'm sure John will give us plenty more in a couple of seconds. I do want to let everybody know that this presentation is being recorded, and we will be sharing the recorded version through an email with all registered participants. So if there was something that you caught and needed to make more notes on, it will be made available to you as soon as we have a finalized version ready to send out. And with that, take it away, John.
Hey, good morning, everyone. Pete, thanks for the introduction. And I think what you heard from Mike is it's not as simple as just opening up an investment account. A lot of times, as organizations are either starting this process or maybe they're looking to make a transition. A lot of those items that Mike went through sometimes get missed, but they're vitally important. They're the foundations of getting to the point of being ready to invest. And so today we want to go through and talk about things that we've seen other organizations be successful at, areas where maybe we've seen struggles from organizations work through different scenarios that come up. And as we know, when we're talking about investing, Mike mentioned 2007 to 2009. That's when I first got in the industry. And I think we all know emotions play a part in the investment world. Now, maybe they shouldn't, but they do. And we have to acknowledge that. And that's no different for an individual, a for-profit business, or a nonprofit. And as we start looking, why is planning important for a nonprofit when it comes to their investment philosophy? And the first step is identifying the goals. We try to keep these processes very simple because at the end of the day, we're trying to uncover what is the ultimate goal here. And very often organizations may not have a clear path to what that goal is. And at the end of the day, if we don't have clear and defined goals that the executive team, the board, and the organization has for the dollars that they're looking to invest, it becomes challenging not only for the organization, but for ourselves to ultimately get to or help create an outcome. We also want to look then at addressing financial concerns and expectations. I think Mike talked about some of those items. What we typically feel is, what are you hoping to get out of this? At a bank account, maybe right now you're earning a very, very low percent, but you have that safety. Is the expectation that you're going to get return above and beyond inflation? Right now inflation is obviously very high. So what is the expectation? What is the comfort level with the organization to accept the risk that potentially is needed to take to get to those financial goals? And then it's identifying what are the things that could pose a threat to your financial future. We're going to talk about different areas of why nonprofits invest, but a lot of times, what if a major donor goes away? What if funding isn't available in the future? What are areas where the dollars that you're looking to invest potentially may need to come into play? Or can they continue to grow for 5-10 years? Those are all things that we want to talk and identify prior to getting to that end goal of actually investing the dollars. And going through this process helps everyone feel more educated, confident, and in control. So, as we go through this year, we have the markets have had volatility. The organizations, and for that matter, individuals who feel that they understand the process that they're taking, they understand the goals that are there, and have gone through, these different, we talked about threats that could pose, to their financial future. Those groups generally are less concerned in market volatility. simply because, again, they have that plan in place. They understand, market may be up, market could be down, and how that might affect, again, the overall goal of the organization. And this is ultimately going to help everyone create a roadmap to achieve those goals. And that roadmap may change as the organization moves on over the years, but it helps ourselves, your investment advisor, whoever you may be working with, and the group, just to make sure, are we on track? And again, if we don't have these goals, it's very hard to identify, are we on track? So again, keep it simple, but make sure that there's a plan in place for how and why you're looking to move forward. A really good question is, why do nonprofits look to invest in the first place? We have a lot of groups come to us and say, hey, we have some extra money we want to invest. Well, why is that? What, again, back to this goal. But a lot of times it's to grow an asset base. Maybe you have an existing, sum of money that you say, we want to continue to grow this. We want to build this. We want to provide some potential financial freedoms down the road. It could be an alternative to savings. Again, looking at, short-term, medium-term, long-term, these are all savings events to some extent. And, outside of a very secure savings account, maybe we want to have something that has a little more growth potential. So is that the goal? It could be to encourage donors or large gifts. We've been a part of different organizations where they've came and said, we have some groups looking to donate money to us, but they want to know, do we have a system in place to invest those dollars? So creating that infrastructure, or if you have an existing one, to be able to explain to a donor, this is how we invest our money. This is the process that we have. That can be very reassuring for an individual looking to give dollars to you or to that organization. Mike talked about reserves and safety net, and that's where a lot of times this investing these dollars and growing that asset base we talked about can become an environment where you can use those dollars to help offset in the event that again, maybe funding dries up, or maybe there's a campaign that you're looking to fund. Maybe it's the buildup becomes so large you can just spend some of the dividends and interest. Maybe you need to spend some of the principal, but it's a way to build that. And then building a legacy, building a situation where your organization, again, I talked about financial freedom, but has the ability to do things that maybe do require capital that without this investment account, without growing an asset base, may not be possible. With all the things we're talking about, and as we talked at the beginning, it's not as simple as just investing. There's a lot of parts that go into us. And even once you've got to that process of saying we want to invest, there's a lot of different scenarios and things that can come up that make and create I think a really key process to how you manage it. So, to start, the cash flow management, again, getting back to really honing in on where are the dollars coming from? What are the expenses? When are things going to be coming out? Managing that cash flow and understanding how, from an investment standpoint, are some of the investments liquid? Are some of them not liquid? And how important is that to the organization? Because that can really affect getting into the investment analysis part of this, of how an organization is structured. We're going to talk in a little bit more detail about risk generating assets and assets that have more conservative nature to them. But creating the investment analysis, making sure, again, that the organization, the leadership team understands how your dollars could be invested. Is that in mutual funds, as Mike talked about? Is that in individual stocks? Is that in private equity? So there's a lot of different ways to build these things, but again, it's making sure that everyone has an understanding of what that looks like. The investment policy statement, we help individuals or organizations create that, as Mike mentioned. Sometimes that's the part that we see organizations really struggle with the most, is in two ways. One, the creation of it. It seems very daunting. And again, it does not have to be as complicated as you may think. Sometimes creating something simple is the best path. But then are you following that? And I think that's where, when we get into, the ongoing engagement part, we've come across a lot of organizations where, yes, they have an investment policy statement, but it's not being reviewed. And the investments may be completely out of line with what the tolerance that the leadership team and the board has came up with. So that investment policy statement, not only is it important to have, to follow, but again, to continue to maintain and make sure that it's still appropriate, because it can be changed. We've talked about the goal setting for organizations to start. Again, that's a very important, that's the first step in this process. The fiduciary education. Do all members involved in the investment process understand the responsibilities that they have back to the organization? If you're on an investment committee, if you're helping create the investment policy statement, financial advisors can help you invest. They can, create the strategy and the ongoing, due diligence of that. But creating that policy and having control over potentially investment decisions, there is some liability to that. So does an organization, do the individuals involved understand that? We want to make sure that everyone does, because again, the more educated everyone is, we feel when things, again, when there's volatility in the markets or there's struggles with funding, it helps create more consistency, which ultimately leads to better outcomes. The ongoing engagement. It's not just creating an investment policy statement, as we talked, and then just letting the investments go. We feel it's vitally important to make sure that, once a year, twice a year, 3, 4 times, whatever that might be, that your organization is understanding where your dollars are at. And maybe it's reporting to the board once a year on that. Maybe it's just to a leadership team. The organizations that we've worked with that have very good ongoing engagement seems to be the organizations that, again, during hard times, they're the ones who can ride through that. They're the ones who are not as nervous. They're not feeling as anxious, because, again, they have a plan, they're following it, and they're educated on it. And that's the key there, is, again, continuing to have that engagement. Looking at spending. Mike talked about who's able to, spend those dollars. We look at it more from a planning standpoint. If the organization thinks that, hey, we may need money in the next 6 months, the next year, maybe it's in 5 years. That's really helpful to understand from an investment philosophy. Again, as we talked, some investments have a longer term nature. Some have a shorter term nature. And how does that portfolio get designed? Maybe those dollars shouldn't even be invested if they have a shorter term nature. But it gives us the ability, or your advisor, the opportunity to position the portfolio in accordance with your policy statement to make sure that you have those dollars in an appropriate fashion. Working with your donors. We've come across scenarios where, a donor may say, I'd like to give a gift, but maybe we want you to hold on to this stock. Does your organization have a donor policy to say, if you are going to donate money to our organization, here's the process we follow. It may be that if it's in the form of stock, that stock is automatically liquidated and invested per then the investment policy statement. But a lot of times that can come up. And if an organization hasn't thought about that, it can catch you off guard. It can create potentially uncomfortable conversations with a donor. So we like to have that conversation up front, make sure everyone's aware. Those are things that could come up. But again, identifying that. So there's a lot of pieces, again, that come back to creating a really strong investment strategy for a nonprofit. As we get into the risk part of this, simple sometimes is better. And there's a lot of different ways to look at risk. And there's not a right or wrong answer to what your organization feels most comfortable. But, financial advisors, we can create really good investment options for you. But if it's not the right fit for the goals and objectives of that organization, then that's not good either. Typically, what we've seen is organizations that we work with in a nonprofit space typically have a risk profile slightly above middle of the road. So if one is the most conservative, that's like a savings account. There's not a lot of upside. There's not a lot of downside. And 10 is as aggressive as you can be. So trying to get the maximum return, but you also have the maximum amount of volatility. 6 seems to be kind of, again, right above middle of the road where most organizations feel comfortable. But we like to have that conversation. That helps, as Mike mentioned, in 2007 to 2009, that organization that saw a substantial downturn in the return and the value of their investments, having this conversation up front, acknowledging that there's periods of times when the market may be down. There's also periods of time when the market may be up, but that goes back to the goal. Maybe the goal again is to get a 3 to 4% rate of return. Well, maybe we don't need to invest as a 10 from a risk level to accomplish that. So it's having that understanding, and not only having that, the ongoing engagement. Is this still the goal? Is this still the right path given the market conditions, given where the organization is at now? Because that does change. So from day one to 5 to 10 years down the road, this may look slightly different. And as we go, this is where we get a little more into the actual investment. And every group is going to have a different allocation of what they use. And there's a lot of different ways to create a very well diversified investment portfolio. We typically look at return generating assets versus risk managing assets. And all the things that we talked about go into what goes into the return generating versus the risk managing. And some of this also depends on size. The larger the investment pool that you have available, there's more opportunity for different types of investments. But those may or may not be a good fit, again, depending upon liquidity, time horizon, some of those items. But, some of the return generating assets would be, kind of core equity. It could be in the form of individual stocks. It could be mutual funds or indexes. That's typically where most organizations are going to have some form of that. And then beyond that, you could potentially look at a private equity. There's alternative investments. That could be ESG. We see a lot of nonprofits, again, want to look at environmental, social governance funds because they feel very strongly in that. And it's having that conversation with the leadership team, the board, to see, is that the right path? Is that the fit that this organization wants to work with? Commodities, real estate, different ways to generate this. We try to share those. And if those are options there, again, address, does it help meet the long-term goals and objectives? And is it the right fit? So again, all of these are options that are out there. They may or may not be either be available in size or the right fit. And then from a risk managing standpoint, you have traditional fixed income. That is your bond portion typically that you're looking at. You have the cash. Is that an appropriate place, again, for those shorter term goals that we're trying to do? So looking at all these different things, trying to come up with a strategy is sometimes challenging. But again, if you've gone through the things that Mike talked about, if you've gone through the goal setting and thinking about all the different things that could potentially come up, it really helps narrow in on what is the right path for your leadership team, your organization, to invest the precious dollars that donors or different individuals have decided to give to your organization. And you just want to make sure that you're doing everything you can to maximize those resources.
All right. Thanks very much, John. Appreciate that. Again, a lot of information to absorb and think about for all of our nonprofits. And it looks like we have a couple of questions that have come up that really are in John's wheelhouse to start with. So Ann Michaels asked, I'm still building my nonprofit and I'm trying to establish an infrastructure for donors to invest and plan bequests to our organization. How do we go about setting that up?
Yeah, that it's a very good question. And it can be as simple as opening up some form of a brokerage account where you would have an account that would be titled in the name of your organization, where an individual could transfer those assets directly into that account, where, it can be very simple. We've helped groups do that, where maybe a donor's for tax purposes is donating appreciated stock that they have, and that could transfer right into an account in the name of the organization. And then again, that's where we've talked about some of these things is your policy then, if you receive that it immediately gets liquidated upon receipt. But if you have questions on that, certainly let me know. But that part can be relatively easy to at least get established and provide a system for providing those donors with the information of how to actually go ahead and transfer and make that donation.
It's a great answer, John. Mike, do you have anything that you would add from an accounting perspective?
No, not really. It's I guess it's just to John's point about whether it's something that some organizations choose to liquidate those right away. Then back to my comment earlier about doing, recording gains and losses and such. A lot of times, if it happens the same day or even the next day, they'll just kind of value the gift that when it's liquidated, because there's probably very minimal gain or loss on a very short period. But no, otherwise, other than that, it's just comes in. The debits and credits are pretty simple. The money comes in, it's revenue, and then it's an asset, and then you just start recording your gains and losses just like any other investment fund if you opened it up yourself.
Perfect. Thank you. John, another one for you. Ann also asked, have you worked with people who do social investing in nonprofits?
That's a challenging question. That means a lot of different things to different organizations or different individuals. We've ran across that more so on the individual side. From an investment standpoint, it's becoming a more common conversation that we have, and there's certainly becoming a growing amount of investment options that are available to organizations to look at that. We typically like to start with what is the actual goal, getting back to the goal, because what we may consider, for example, ESG, social governance funds, environmental social governance funds, may be different than what you're thinking. So again, it's making sure that we line that up and see if what you or your belief structure is, if there's an area to do that in a prudent way. Obviously, that's the other part of it is we don't want to take away some other aspects from an investment standpoint, a diversification standpoint, without explaining maybe the risk of that as well.
Perfect. Thanks for that. It is an interesting topic that we are hearing more about in the banking industry as well, and I anticipate that it will continue to be a focus for the next several decades, not just years. We have one more. Val Harchis asked a fantastic question, and maybe we'll tap both John and Mike for different perspectives. She wants to know how our changing rate environment is affecting investment portfolios, and I would add on how that is leading to budgeting conversations that maybe Mike is having with the people he works with.
I'll let you go first, John.
Hey, I was going to say, I was happy to let you answer that. No, it's a very good question, Val. As rates have continued to rise, we talked about the common investment allocation is roughly 60% risk generating, 40% kind of risk neutral type, or that fixed income portion. And as interest rates continue to climb, that has put downward pressure on fixed income. So it's lowered that, it's created more volatility in the fixed income. Now, down the road, there will be a reset where as rates continue to climb, those fixed income assets at some point will have a higher return there. But the last few years of this low rate environment has caused some groups to say we need to go up in the risk level to try to generate the returns to make up for the lack of returns from the fixed income side. And what you're seeing now is that created more volatility in your portfolio. So it's a very challenging environment. I'm sure, Pete, you can, on the banking side of the safety that you're looking for, but also, again, trying to get performance above and beyond that safety. And right now, unfortunately, safety is not paying very much. And so you have to navigate what's more important, the safety part or trying to go after the performance, but there can be downside consequences. And maybe just the last piece I'll add there is then it's also trying to look at what are things that are alternative to just traditional stock bond allocation. And that's a growing area that, you continue to look at of how can you generate some returns without, again, additional risk, but that's different than just your typical stock bond allocation.
Thanks, John. I think you're right. It's a challenging environment, and that kind of leads me into my second half of the question with Mike. It's a conversation we are having with clients at the bank. How are you helping people start to think about budgeting in light of the low returns and the high inflationary pressures that everybody is feeling in all aspects of their enterprise?
Yeah, I think you guys said the word like 3 times. It's accurate. Is challenging because it is not just the rates, but it's the inflation and the cost of everything. So trying to maybe give potentially larger salary adjustments than in the past to based on inflation and cost of living and just other expenses in general, just whether it's office supplies or anything, like everything's going up, but now maybe our rate of return isn't, really hasn't been lately, obviously, but just in general, when there's these rate of return challenges. So, hopefully it's been very positive the last couple of years, how many organizations really had good years, even with the pandemic. Not everyone, but a lot of organizations had solid years with the pandemic, despite the pandemic, and using PPP money and ERC credits and other things that hopefully help them really get through some potential cancellation of events and other things. And saw a lot of organizations that maybe even had better years than 2019 or leading up to 2020. But I think right now what we're going to have seen a little bit of and maybe even see more potentially moving forward here, since a lot of times naturally organizations with 2022 budgets, those were probably done 6 months ago plus, is I think we are going to see more organizations just having to dip into or maybe relying on the investment return to balance the budget, as opposed to in the past, my comment earlier about like, hey, let's try to budget break even or better without investment return. And then that's sort of our gravy or our money that we can use to build reserves and do some other things that maybe we don't have to do, but we'd like to do. I think we're just going to see more organizations planning on using the investment return and or maybe even just dipping into some of the principal potentially in the short term here, and realizing that's not a long-term sustainable plan, but might just be very necessary for budgetary reasons here for 22 and maybe into 23.
I think that's a well said, Mike. It's a challenge we're all going to feel for the next several months at least. And hopefully with the advice of great professionals like you and John, all of our clients and the Madison community organizations will be able to make their way through it less scathed than they might if they didn't have your help. So once again, I'd like to thank everybody. We are close to time, so we will be wrapping up here. I want to remind you that we will be sending out a recorded version of the webinar for everybody to review if they need to look at any of the slides. You all will also have our contact information if you have additional questions or maybe something that's a little more specific to your situation that you think Mike or John could help you with. Mike, John, thank you very much for sharing your time and your expertise. It's been a great hearing from you and getting your perspective. You guys have given everybody a lot to talk about, I think. And with that, all of our attendees, thank you very much for taking time out of your day and spending it with us. We hope you learned something, and we look forward to seeing you at our next webinar. Thank you, everybody.